Good afternoon, ladies and gentlemen. A very warm welcome to another virtual seminar organized by the Seminars and Conference Committee and Taxation Committee of the Institute of Certified Management Accountants of Sri Lanka, the National Professional Management Accounting Body in Sri Lanka, incorporated by an Act of Parliament. CMA has always played a lead role in the digital environment to update the knowledge of its members by organizing continuous professional development CPD programs for its members and students. The presentation on 25% surcharge tax will be delivered by Mr. Atula Ranavira, Managing Partner, Ranavira Associates, and Mr. Suresh Pereira, Principal Tax and Regularity at KPMG. This will be followed with a panel discussion moderated by Mr. Duminda Pulangamua, Tax Partner, Ernst & Young. And the panelists are Dr. Kuladunga Rajabaksha, Managing Director, DSI Samson Group of Companies, Mr. N.R. Gajendran, Senior Partner at Gashma & Company, and Ms. Reemanji, Head of Corporate Finance, Group Tax and Social Entrepreneurship Project at the John Gills Group. I also warmly welcome CMA President Professor Lakshman R. Vattavala, President of SAFA and Vice President of CMA, Mr. Henaka Bandara, Council members, members of CMA, invitees, ladies and gentlemen. To commence the program, I have pleasure in inviting Professor Lakshman R. Vattavala, Founder President, CMA Sri Lanka, to deliver the welcome address and introduce today's topic. Professor Lakshman R. Vattavala has led the Sri Lankan accounting body, starting with the Chartered Accountants, the South Asian Federation of Accountants, founder of the Accounting Technicians, and founder of CMA Sri Lanka, and SAFA board member and chairman of SAFA International Relations Committee. A proud receiver of the Sri Lanka National Honors of Sri Lanka Sihamani in 2019, installed in the Hall of Fame of the Institute of Chartered Accountants, and was awarded the Lifetime Achievement Award by CMA Sri Lanka. He is also Professor Deakin Business School, Department of Accounting, Faculty of Business Law at Deakin University. Professor Lakshman R. Vattavala, I am honored to invite you to deliver the welcome address and introduce the topic. Over to you, sir.
Thank you. Thank you very much, Mr. Gajendra. I think I should introduce you briefly. Mr. Gajendra is a member of the Council of CMA Sri Lanka, and he is also the chairman of the Taxation Committee, and is one of our new members who's playing a very, very important role and helping the council. So thank you very much for that introduction. Our learned speakers, our panelists, and also our president of SAFA, Mr. Henaka Bandara, our council members, ladies and gentlemen. And of course, our members of CMA Sri Lanka and other invitees who are present here. Let me welcome you to this webinar that we are organizing on the proposed surcharge tax of 25% on taxable profits of 2021. As a national professional management accounting body in Sri Lanka, we have a duty to perform. That is, of course, to make our members knowledgeable and also inform them what this proposed surcharge tax is and also the impact that it will have on the businesses. As management accountants, we have a very, very important role to play, because the budget, this time's budget is talking of very, very important areas on both financial, expenditure management, cost management, and of course, various management techniques such as KPIs, restructuring of SOEs. So many things are there, and this proposed surcharge tax is also what was there in the budget speech. So you will all know that one of the reasons for putting this surcharge tax, of course, is to increase the revenue of the government. Now, generally, all governments, if you look at most of them, they have their revenue is about 30% of the GDP, but unfortunately in Sri Lanka, it is very, very low. And maybe that they have thought that they should put a tax. But there are two important things in this, our statement that is there. One is, of course, the surcharge tax of 25%. Other one is on the profits of 2021. So we have talking of previous years. Generally, we are forward-looking people who are looking at current years, and we know definitely that these would not have been budgeted in the accounts of any of the companies, because these are things that have been put on previous year. So it will cause a lot of problems. And the surcharge tax is a new amount that will have to be charged. So there is a lot of maybe debate and also problems that will be encountered by companies. First of all, the COVID-19 pandemic has had an impact on all companies, both, and also the government. The government also has been giving a lot of subsidies and trying to help. Similarly, the companies have to manage and to take various measures. Then, of course, the foreign exchange problem that we are currently faced with. That too, the foreign exchange is earned by the private sector. So the private sector is a very, very important segment in the whole economy of this country. If you look at it, the budget, 60 to 70% is for the government sector. They are all for the government ministries and others. So the money that has to be earned is from the private sector. So the private sector has to shoulder a lot of the burdens of the spending. So government must also know that if we are going to put additional surcharges, then they also have to drastically reduce expenditure in all areas. So that's the first thing that we have to keep in mind. Then if you look at this, one of the other things is most of the companies would have planned their future. So that means they have planned for the year 2021. Now they are going for 21-22. So what would have happened is they would have spent most of the money that they have earned either on capital expenditure, on their expansions, going into maybe new export projects. So then what is going to happen? Now that is the biggest question that we are having. Then the other important thing that you have to keep in mind is that all these companies, now they say these are the big companies, but certainly like what we formed the SME COVID-19 SME fund, we have similarly, we have to see the impact on the big sector, because they are a very, very important sector. They are earning the valuable foreign exchange. Then employment. Today, the largest amount of employment is created by all these big companies. Now, there was a big, I think in the parliament, there was a big debate that was on the Employees Provident Fund, the Employees Trust Fund, where they were going to tax them. So that was very unreasonable, and ultimately the government has made a statement, the Honorable Finance Minister has made a statement that this is not going to be done. But certainly, all these employees are working in the private sector. 90% maybe private sector. And who's paying their EPF and ETF? It is paid by these private companies, these quoted companies, because quoted companies are a very, very responsible lot. They are, most of them are quoted on the Colombo Stock Exchange. They are looked after by the Securities Exchange Commission. So they have a lot of responsibilities on their part. So I think the government also needs to look at this in a much more realistic way, like what they have done for the EPF and the ETF. First of all, whether the 25% is a realistic tax, and whether this should hamper the development of the economy of this country. The second one, whether it should be charged on 2021, which means that they are really going to be in drastic problem. So let them plan if whether we can then maybe spread it over 2-3 years, or work it out in such a way, because I think the private sector is always prepared to help. But the private sector also has to look after their employees. But if they are to look after their employees, then they must also generate additional income. They have to do all these things. So these are important matters that one has to look at, because sometimes because they are big companies, very few people look at them. Only when they want some maybe contributions, other things they will come. But when the tax is imposed, they are all silent. But I think they should do the same thing that they did for the Employees Provident Fund and the Employees Trust Fund, to look at it in that spirit, because all these employees are making these contributions through these public quoted companies, the private companies that are there. So the big companies have a major role to play. So I think I'm sure that today we have very, very eminent speakers. One would speak on the bill that is being presented, the other one on the impact of the surcharge. So on the business and commerce. and then of course very eminent panel. I think they've already been introduced. So I'm sure that all of us will be able to put something together to tell the importance of this bill and how the private sector and these big companies should be treated in order that they can also contribute to it, but without hampering their growth and the economy of this country. So once again, I must thank all our speakers and panelists for sparing their valuable time to be with us. And I'm sure that this is going to be a very important debate that we are going to have. But this should also be publicized, whatever that is there, and then that public opinion should be created for these companies, similar to what was done for the EPF and the ETF Act. So I'm sure that this webinar will create a great deal of interest and would really bring the true facts to the stage and give the private sector a very good place in the society of this country. Thank you, and all the best to you.
Thank you, sir. Next on agenda is the discussion on introduction to the surcharge tax bill by Mr. Atula Ranavira, Managing Partner, Ranavira Associates. Mr. Ranavira is a fellow member of the Institute of Certified Management Accountants of Sri Lanka, the Institute of Chartered Accountants of Sri Lanka, and the Institute of Accounting Technicians of Sri Lanka. He also holds honors degree in Business Administration, BSc in Business Administration from the University of Sri Jayawardenepura. Mr. Ranavira counts over 4 decades of experience in the accounting profession. Further, he is a consultant to SN Secretarial Services, Secretarial Consultants Private Limited, engaged in company secretarial services. In addition to the audit practice, Mr. Ranavira has a wide experience in tax, company secretarial services, and in investment advisory and promotions. Over to you, sir.
Good afternoon, everybody. Yeah, today's topic is proposed surcharge tax of 25% on the taxable income. Now, still this is on bill stage. The act is not passed in the parliament. I will take maximum of 25 minutes for my session. I will brief the content of this particular law. To support that, I will share a document, a PowerPoint presentation. Yeah. We'll talk about the insights of surcharge tax bill, which is gazetted in February 2022. Yeah. Now, in this presentation, I'll be covering the content of this bill, that is imposition of surcharge tax, then the surcharge tax returns filing and the tax treatments and the accounting treatments, then tax administration, then important interpretations and the public concerns on that. Now, imposition of surcharge tax. As in Sri Lanka, in most of the other tax laws, the section number 2 is the charging section of the tax laws in Sri Lanka. Now, accordingly, even in this, the section 2 covers the imposition of surcharge tax. It says this is applicable under section 2(1). It says it is applicable to any individual, partnership, company. There are 3 people. They are individuals, partnerships, and company whose taxable income exceeds ₹2 billion. That is the liability threshold. The liability threshold is ₹2 billion, 2,000 million. The liability period is year of assessment 2020-21. Now, this first sentence itself, it covers the liable person and the individual, partnerships and company. Then the taxable, the threshold is 2 billion on taxable income. Then the year of assessment, the base year of assessment is 2021. Then the tax rate as per the law is proposed 25% of the taxable income. Now there's a small issue on this. It says 25% of the taxable income. Suppose now according to that, any person whose taxable income go beyond 2 billion the year of assessment 2021 is liable for this tax on the entire taxable income. Now there's no relief up to 2 billion rupees. That means now suppose 2.1 billion, then on whole 2.1 billion we have to pay tax. Now by reading that, we can understand that there's an unfair situation. Suppose a person has a taxable income of 1,900 million. That is little less than 2 billion. Then that person need not to pay any tax. But suppose the taxable income is 2.1 billion, even 1 rupee more than 2 billion. Then he has to pay 25% of that. That is 500 million plus. Then payment of tax. According to the law, according to the bill, the tax, once we calculate the tax amount to be paid in 2 equal installments. 2 equal installments. Then the dates are first installment to be paid by 31st March 2022. Second installment by 30th June 2022. A short time period. Still the law is not passed in the parliament. We have only 4.5 months to pay off the entire tax amount. Now, by making such a payment by a liable person will badly affect to the liquidity situation of that entity. Now, in this case, the liable person, when we talk about the liable person, individuals, partnerships, the word company, it says we have to apply the interpretation given in the Inland Revenue Act number 24 2017. As per the interpretation given in the Inland Revenue Act, a company means a corporation, unincorporated association, or other body of persons. This is the main clause in that interpretation. A company means a corporation, unincorporated association, or body of persons. This is given in section 195 of the Inland Revenue Act. Now, by reading this company need not to be an incorporated one. It may be incorporated one or maybe unincorporated one. Like associations, various body of persons and all also comes under this particular definition. That is the reason why a lot of people are shouting or a lot of people are making their voices on this liability on companies, because it includes even the employees funds like EPF, ETF, funds like that also covered with this company definition. Right. Now we'll move forward. The effect of subsequent liquidation. Now we understood who is liable and on what threshold applicable and at what rate. Now next is sometimes due to various reasons. Now the company, now the base year is 2021. Now almost 11 months or almost 10.5 months has passed. By now, some of these companies, liable companies, may be in a liquidation situation. Now, if it is the situation, because this company say, a company definition, they say companies including subsidiaries and holding companies. As the company for this tax liability includes a subsidiary company as well as a holding company. That means to meet this 2 billion turnover, 2 billion taxable income, to see the 2 billion taxable income, we have to take the group taxable income, not individual companies taxable income. Suppose this is, we have to apply the entire group's taxable income. When we are totaling up this entire group's taxable income, if there are any company, if there's any company which is under liquidation now, just because it is under liquidation subsequently, it doesn't mean that that particular company is not liable for this tax. Even that company's taxable income is liable for this tax. Subsequent liquidation is not an issue. Then we'll see what is the taxable income. It says the taxable income is the taxable income what we have calculated for the income tax purposes. That is, under the Inland Revenue Act number 24 2017, we have already calculated and paid the taxes and filed the tax returns with the Inland Revenue Department. Here the taxable income base for this surcharge tax is the taxable income what we have computed under the Inland Revenue Act for 2021. Okay. Now, in Sri Lanka, not all the income tax liability is not only under the Inland Revenue Act, but also under the BOI law. Earlier, as we know, under the BOI law, they were giving various tax holidays as well as they were offering concessionary tax rates. Suppose this is a company which is enjoying a lower tax rate, concession, whatever the tax rate under the BOI agreement, under the BOI law. Then even in that case, we have to take the taxable profit computed under that BOI agreement. That is, anyway, it is under the Inland Revenue Act we are calculating, but the governing body of that income tax is BOI law. Then there it says from that taxable profit, from the profit before, it says profit before income tax and surcharge tax. We shouldn't take the income tax and surcharge tax as a deduction to arrive the taxable income for the purpose of surcharge tax. Then there are 3 exclusions given under this law. 3 exclusions for taxable income. We'll next we'll see what are the exclusions. In calculation of a partner's taxable income, in the case of a partner's taxable income, partner's income from partnership, that particular partner's income from partnership on which the tax has been paid by the partnership. Now, suppose this particular partnership has already paid the surcharge tax. Now, in future, the partnership, suppose the particular partnership is liable. Then first the partnership pays the surcharge tax. As the partnership is paying surcharge tax, the individual partner is not liable to surcharge tax on that particular partnership share of profit. That is what it says. Then the next, in the group companies, the group taxable income excluding dividend income from the subsidiaries. Now, as I mentioned earlier, suppose there are 10 companies in the group, we have to total up the taxable income of each company of those 10 companies. Then that total taxable income, if the total taxable income goes beyond 2 billion, then we have to pay 25% surcharge tax. Now, when we are totaling up this taxable income of each company, we have to eliminate any dividend received from that those subsidiaries, because that is within the group. Therefore, we have to remove that part. Then next, any company in a group having nil taxable income shall not be taken. I don't know why, what made them to include this part, because when it is nil taxable income, due to losses, there may be cases where certain companies, they don't have taxable income after claiming the brought forward losses or due to the current year's loss. Now, in that case, when we are totaling up these companies, taxable companies, particular company, obviously that company's taxable income is zero. The company, the value what we are giving for that is zero. Therefore, I think the reason why they have included maybe that to say that there's no possibility of deducting the losses from
Sorry, can't hear.
or some signal issue, we will move for returns and the treatment for income tax and for VAT purposes and for accounting. Surcharge tax return. Surcharge tax returns
We can't hear you.
return on or before 31st March 2022. Now, on or before 31st March 2022, we have to file the tax return. The last date is 31st March 2022, including subsidiaries and holdings. Now, this subsidiary, the total amount, we are calculating the total amount only for the purpose of meeting that threshold of 2 billion. But tax payments to be done by each company on their each company's taxable income other than the group dividends. Right. Then return to be filed by 31st March 2022. Then for Surcharge Tax Act, the surcharge tax return so filed shall be treated as a self-assessment return filed under the Inland Revenue Act. Under the Inland Revenue Act, these self-assessment returns, there's a thing called self-assessment return. Now, once we file this surcharge tax return, it is equivalent to, it is treated as equivalent to the self-assessment return filing under the Inland Revenue Act. Then treatment of surcharge tax for income tax and VAT. What are the treatments? Then surcharge tax is not an allowable expenditure for income tax purposes. When we are calculating the income tax, we can't deduct the surcharge tax as an allowable expenditure. Similarly, when we are calculating the financial VAT, this surcharge tax of a finance company, the financial institution, is not an allowable deduction. Then how to account for? It says the surcharge tax deemed to be an expense in 2020-21 accounts. Now it is too late because 2021 accounts we have already finalized. We have the AGMs and finalized everything and paid the dividends and return filed, everything done. Now they are saying to include this expenditure into 2021 return.
Excuse me, Mr. Atullah, shall we put the presentation from our side? You want us to put the presentation? Shall we put it from our side, the presentation?
Can the presentation, you all can't see the presentation?
No, we can't see. So we will put it from our side.
No, that's okay.
Huh? You don't want?
I'll continue like this.
Okay.
Then tax administration. Yeah, I'll see.
I think better you do without the presentation, otherwise. because
Now
of
can
the-
you see the presentation?
No, we can't see. It's okay. You continue. Yeah.
Right. Next, tax administration. Tax administration. Now the tax, under tax administration, Inland Revenue Act sections, it says the Inland Revenue Act sections to be applied. Inland Revenue sections to be applied. Now, under the Inland Revenue Act, there are so many sections which relate to the tax administration, mainly tax administration, then the record keeping, information collection, tax returns, assessments, appealing, objections, tax liabilities, interest penalties, and criminal proceedings. And for all these things, it says that we have to apply the Inland Revenue Act conditions, whatever the sections applicable in the Inland Revenue Act. Right. Then next, defaulting of tax payments and actions thereon. Suppose somebody default this particular tax payment, any Surcharge Act liable individual, partnership, or a company defaults, it is to be treated as a defaulter. Whoever the person who defaulted is treated as a defaulter. Then the assessments can be issued against these defaulters on or before 31st December 2024. On or before 31st December 2024. Then the tax assessed to a partnership can be recovered. Now, in the case of partnership also, under this law, taxes could be claimed. Taxes liability may be there on a partnership even. If the tax liability is there on a partnership, then can recover that amount from the partnership, a partner, or an agent of the partnership. The recoverability is extend to the individual partners as well as to the agents of the partnership. Then that's all which relate to the existing law, but there are few important interpretations. We will see the interpretations. Now, under the group company, because this law covers the group company to arrive at 2 billion turnover, 2 billion taxable income, right? When we are calculating 2 billion taxable income of a group, we should know what is a group. Now, it is explained, group companies means a holding company and its subsidiaries. Holding company and its subsidiaries. Then we should know what is a holding company and what's a subsidiary. Now, in this case, these definitions are different from the Inland Revenue, Act. Holding company says, holding company means a company which owns more than 50% voting shares. 50% voting shares. The voting rights should be more than 50%, right? Directly or indirectly. Then it covers any other than, there are two types of companies are excluded. One is companies incorporated outside Sri Lanka. The other category is overseas companies registered in Sri Lanka. The things we generally call as branch office, those branch offices are excluded from this tax, as well as any overseas incorporated companies are excluded from this tax, from the holding company category. Because otherwise what will happen, we have to take the holding companies, overseas holding companies taxable income also for this purpose. Therefore, they have removed that. Then subsidiary company. Subsidiary company means a company in which more than 50% of its shares of voting right are owned by another company. again, 50% voting right. Even in that case, overseas companies and the companies incorporated outside Sri Lanka are removed from this. Then, when we take the company partnership and year of assessment, the same definitions are there in the Inland Revenue Act. There are some definitions in the Inland Revenue Act. We have to apply the same definitions here. Right. Now I have gathered some questions like the entrepreneurs and the public concerns for further discussion. I'll just list down these things and keep it open for the discussion later. One is, some argue that this is a duplication of tax because these companies, they may have already paid 14%, 14%, 18%, 24% or 40% income tax. This is over and above this that tax. Then the effect on foreign direct investment. Why sudden introduction of this type of taxes are badly affecting to get overseas win overseas investors.
Sorry,
Then
Mr. Atul, is this
tax,
slide okay?
Is
this slide okay,
yeah.
Or this is okay?
Sorry?
No, we have put the slide. Can you see it?
Yeah. After this
okay?
tax, what's left for investors? Because now in the case of a liquor manufacturing company, they have already paid 40% and also 25% now, altogether 65%. Then unfairness of charging for a past period. Then effect to the tax principles of the payment ability, the liquidity situation. Then why a high rate of big tax instead of a lower rate on widen tax base? Then why not only on the excess of 2 billion rupees? Then why based on group taxable profit instead of each entity? Then effect to the employees' retirement funds, EPF and ETF, which is liable now. At the present, it is liable. The future of liable person, because now once they pay this tax, how to plan their business future? Then there's the risk of repeating this, continuing this tax for another couple of years. Some people feel like what has happened earlier in certain cases, it might repeat for another couple of years. There's a risk. Now that's all what I have to mention as a briefing of this tax law. Now in the discussions, time we will discuss the answers or situation which relate to these public concern. Thank you.
Thank you very much, sir. Moving on, Mr. Suresh Pereira will discuss about the impact of surcharge tax bill on industry and commerce. Mr. Suresh is the principal of Tax and Regulatory Division of KPMG in Sri Lanka. He counts over a decade of experience in the areas of tax and regulatory services, including entry and exit planning, domestic and international taxation, investment structuring, mergers and acquisitions, facilitating regulatory and licensing approvals, and representations before authorities in number of sectors. He holds a Bachelor's of Law, LLB from University of Colombo, and is an attorney at Law Supreme Court of Sri Lanka. He is a registered company secretary, notary public, and commissioner for oaths. He is a fellow member of the Chartered Institute of Management Accountants UK and Chartered Global Management Accountant. He is also a fellow member of the Institute of Certified Management Accountants of Sri Lanka. Over to you, sir.
Thank you. Let me begin by thanking Professor Wattawala for inviting me to address this gathering. And I do have a set of slides to be shared. So I'll take that. And I hope we can, everyone can see my slides. Yeah.
We can see, yeah.
Right, fine. Okay, now I will actually start from where Mr. Ranavira stopped, basically, right? Now, when we are talking about this new surcharge tax, I think we can see there are two sides to this story. The opinion is divided. Is this a good tax or is it a bad tax? Now, the people who want to justify this tax, I'm sure basically will be using this Adam Smith's principle, that the concept of equity in taxation, that the broader shoulders must bear the burden and tax should be charged according to the proportionate, that is the tax should be levied according to the proportionate to the income concept. And also this very fascinating quote, the art of taxation consists in so plucking the goose as to obtain the largest possible amount of feathers with the smallest possible amount of physics. So this is something that I'm sure the people will remember when this kind of a tax is being introduced. But okay, this is not the first time that we have seen this tax, and I think the concept of surcharge tax has been there for many. I've seen many statutes, but before going to that, I want to look at the other side of the story. Why is this surcharge tax? Can we justify? Can we use these tax theories and justify and say that, okay, look at the canons of taxation, etc., and say that this tax can be justified? So, issue is, why are we going for the surcharge tax at this time of the period time? Now, we saw super gains tax in 2015. And why? So, are we going to expect this kind of one-off taxation on broader shoulders periodically? Is that justifiable? Now, to me, basically, why this tax is required at this time is because of the things that happened in the recent past. We had this concept that we need to broaden the tax base in Sri Lanka. And I think for many years, we have been trying to do that thing, to get everybody into the tax net, as many taxpayers as possible into the tax net, so that we can collect taxes, so that we could improve the tax to GDP ratio in the country. But at the same time, the revisions that happened, the changes that happened in the recent past, that basically, I think we just forgot this concept of the need to broaden the tax base. And what did we do? If you look at this impact of these changes, that is basically revising the VAT threshold from 12 million to 300 million, and even the individual income tax threshold taking up. Basically, it's 1.2 million used to be the employees, and 6 lakhs used to be the case of the self-employed or the individuals, and that went up to 3 million. And also we had this concept, I think I can recall about 2013, 2014, we decided to eliminate the tax holidays or to reduce the tax holidays and not to go for tax holidays. That was a policy decision. And again, we see that it is being reversed, and tax holidays have become the norm again. So this concept of broadening the tax base has been abandoned. And also the efficiency in the collection of the taxes. Now we basically revise the pay system or abolish the pay system, and we also changed the withholding tax mechanism, abandoned that one, and then also we have seen the revision to the VAT rate from 15 to 8, and also the income tax rate reductions. Now all that contributed to, in my opinion, the requirement to introduce surcharge tax. I think voluntarily we underwent reduction of our tax base and the collection of taxes, and now to cover that gap, we are bringing the surcharge tax. So can we justify that surcharge tax that is being introduced now using these Adam Smith's canons of taxation and all these concepts? To me, I have a big question mark. Right. So in 2015, we did see the super gains tax, but that's not the beginning of this concept. Now you can see starting from 1981, 82, and 89, this concept of surcharge tax we have witnessed in this country, right? On calculations have been different, but this word is something that we have seen. Now, before we go into the retrospective aspect, again, I want to pinpoint another aspect. We have also witnessed in Sri Lanka periodical introduction of amnesties. So instead of improving the collection mechanism, strengthening the collection mechanism and collecting the taxes from the tax defaulters, periodically we can see in Sri Lanka, we do keep giving tax amnesties. And then it seems now, periodically, we are going for one-off taxes to collect the gap. Again, can we justify this thing? So, what exactly is the reason here? I think the reason for the surcharge tax is the shortfall in our proper tax policy planning. I think that's the reason. So from that aspect, I think we can't justify the introduction of the one-off surcharge taxes in this manner. I'm sure most of us expect that this will happen in the future again also. Right, now let's look at another interesting aspect. So we have been discussing about this retrospective aspect with regard to this tax. Now this tax is to be charged to the financial statements of 2021. Same as the super gains tax. Super gains tax also that it was to be considered an expense in the previous year accounts. Is that allowed? Is it legal? Now that's a question that was never asked in 2015. But let me give you insight into this aspect. Right now, the Constitution of our country, Article 75, I have reproduced it here, permits retrospective laws. So on the face of it, it seems the retrospective laws are permitted in the Constitution. But it's not without a qualification. That's something that we have to keep in mind. There is this principle: vested rights or rights that have been acquired, vested rights or acquired rights cannot be impacted by retrospective legislation. So this is a principle that we find, and there's a small condition or qualification that we need to mention when you look at the interpretation ordinance section 6.3. This concept is coupled with introducing a new law by repealing an existing law. But here we don't have a scenario like that. So can we still rely on this concept? Vested rights cannot be amended retrospectively, notwithstanding the Article 75 of the Constitution. This is something that I think we all want to keep our fingers crossed to see if someday this happens to go to courts, how the courts will look at this aspect of it. And also we have to keep in mind the impact of this. Now, I think Mr. Ranavira pointed out 2021 accounts have been audited, everything is over. It's basically a closed chapter. Dividends have been paid, and basically under the Companies Act, when in order to pay dividends, the board of directors must ensure that the company fulfills the solvency test. Assets should be greater than the stated capital and the liabilities. And if in violation of the in breach of the solvency test requirement, if the directors happens to declare dividends, the Companies Act team goes on to give the consequences also. A director also comply the return. So you can see that the director will be guilty of an offense, and there is a penalty also given. So now all these kind of things gets triggered when this kind of an expense is introduced with retrospective effect to the 2021 account. So all these factors I think should be considered if this matter is to be contested in a court of law. Right. Now there's another interesting aspect also in relation to this retrospective aspect, right? Now we are in 21-22. The liability here is for 21-22. Again, this requires a little bit of more interpretation, but we are looking at the accounts of the preceding year. Now this concept of basically using the preceding year, what you call the preceding year basis, or looking at the results of the preceding year for determination of the liability for the subsequent year, we have witnessed in so many other things also, right? So this concept of deemed dividends distribution that was there under the 2006 Act, That also was based on this concept, and the super gains tax also there. Now we find surcharge tax also is based on this one. Now the interesting point here is, if the company is not in existence here, but it was in existence here in this year, should this tax be paid? Very interesting point that should be looked at, right? When we are, I'm not going to conclude there, but point that we should look at. Specifically in the context of there is a reference to no subsequent liquidations will give any relief for super gains surcharge tax aspect of it. How that will be looked at. This is a tax principle, right? Right. There's another thing most probably that we will see in relation to this retrospective aspect. There may be a document or a guideline, what we call a statement of alternative treatments that may come from Institute of Chartered Accountants, similar to what happened in 2015. This is the document that was issued by the Institute in 2015 as to how to account for it. And there were two things in that document: to charge it to the retained earnings and a disclosure to be made. So I think something of this nature may happen in this time around also, depending on the developments. Right, what I mentioned there. Now, this liquidation of a company, there's a reference in section 2.6. Now, the wording I have reproduced. Any subsequent liquidation process of a subsidiary or holding company or group of companies shall not indemnify such company from the liability of paying tax under this act. Not indemnify such company. So that this contemplates, this is not going after directors. This is going after the company. So for this to happen, number one, the company should subsist. And there is this reference to subsequent liquidation. So subsequent to what? That's not clear in this act. It's a very vague reference that is there. Any subsequent liquidation process of a subsidiary of the holding company. Are we talking about after 2021 liquidations, or after introduction of the act liquidation, or what? Not very clear. And it's also, keep in mind, it's restricted only to this word liquidation. There are so many other things that can happen other than liquidation. Right. So this is what I want to pinpoint one. So basically, liability, it's according to the financials, it's liable for 2021, but the company is not in existence in 2020, 21, 22. What is the situation there? Because now this kind of a situation could have happened due to a corporate restructure, a corporate action, or even a liquidation that has taken place prior to the introduction of the act. So how will that be looked at? This interpretation of this phrase becomes relevant. Now let's move on to another area. Now BOI companies is another one I think that we keep debating. The exact wording in the bill is here. Now what I want to draw your attention is, here the reference is become liable to income tax determined in accordance with such agreement. So now we are called upon to interpret this phrase, determine accordance with such agreement. To me, this is capable of a broad interpretation as well as a narrow interpretation. Right, now what's this one? I believe basically everybody understands this concept here, but it, according to Mr. Ranavir explained, a BOI company, after the expiry of the tax holiday period, how it will get liable for tax basically is what this section is talking about, how to calculate the taxable income, whether it should be PBT or whether it's a taxable income that should be looked at, the issue. And so two scenarios. Now basically we can have a BOI company, section 17 BOI company, that was exempt from income tax in 2021 and 21-22 also. In other words, tax holiday is continuing. If this is the case, those companies need not worry, there is no surcharge tax. Then we do have a scenario, the second scenario, where tax holiday was there in 2021, but the tax holiday ended in 2021 and the liability commenced from 21-22. Do they have to pay, does this company have to pay a surcharge tax? The answer there again is no, they don't have to pay a surcharge tax, because if it was exempt, it was in the tax holiday in the during the year 2021. It was its income was exempt. If the income was exempt, that would not have been included in the taxable income. Therefore, no liability. But however, if you are in the third category, in 2021, it was liable for income tax, and from 21-22, a tax holiday commenced. If that's the case, then it's liable, right? Because during that year, if the company had 2 billion, or you can become liable for surcharge because it had 2 billion, or being a part of the group company with more than 2 billion. If because of any of these, either of these two incidences, if this was liable, it was liable for income tax, then keep in mind this third category is liable for income tax, not the first two categories. And then comes the question of companies enjoying SDP holiday. What is the situation? Again, answer is there is no reference to SDP in the bill, but keep in mind all the STPs that have been granted are still in the tax holiday period, and there will not be surcharge tax liability, because the exempt income will not form part of the taxable income. Because of that principle, STP companies in Sri Lanka will not. Now, BOI companies, now this is what I want to speak a little bit in detail. There are three types of companies, three types of wordings or companies that will fall within this category, that can fall within this category. Determination in accordance with such agreement phrase, that phrase, this section that was there in this section, right? Section 28, this particular section. This is a clause, this is a phrase that is there. What will fall within that? Now we have the first straightforward category. I don't think we have agreement, we have a debate in relation to this one, where the agreement provides an option for the taxpayer. Now, if the company, if after the BOI tax holiday period, if the BOI agreement grants an option to the taxpayer to go on calculate the tax liability, let's say 2% on the turnover to be the tax liability, or 2% of the turnover to be taken as a taxable income, and on that a tax rate to be applied. If that formula is given, that option is given, and that company is using that, then that company has to use the PBT. Not taxable income. So I think we won't have a debate in relation to that. That's straightforward. Where the option has been granted and the taxpayer opted to calculate the tax liability under the IRA, because of the option, can we say that whether this company should look at the PBT 2 billion or taxable income 2 billion? Now that's where basically the interpretation will have to be adopted, and that's this phrase where basically says the formula for determination of the tax liability is coming from the agreement. So if you have a clause like this in the agreement, if you take a broader interpretation, you can say that both these types of companies can still use the PBT criteria, notwithstanding using the option and calculating the taxable income using the IRA rules. But still, since the formula is coming from the BOI agreement, if you look at the broad interpretation, yes. But if you look at the narrow interpretation, no. So interpretational issues that are there, right? I'm just highlighting the possibilities. Now, if you look at the rationale of this phrase, why this has been included, because normally BOI companies do not calculate the tax. BOI companies calculating the 2% criteria normally don't calculate the taxable income. Therefore, they don't have the numbers ready. Therefore, basically, only for them this criteria PBT to be used is given seems to be the how to say opinion that is coming from I think the official sources. But what I'm trying to say is it need not be the case, right? It could be the other way also. But then from a taxpayer's point of view, you have to check and see whether it's better for you to argue whether PBT is good for you or whether taxable income is good for you. Right. The second category of company, that is where the agreement, BOI agreement itself provides for a lower rate for a period. Tax holiday for 5 years and thereafter the next 3 years at the rate of 10% and thereafter calculate using the rules given in the Inland Revenue Act. So this second category of companies, also the formula is coming from the formula for determination is coming from the BOI agreement. So can they use, so for them, should it be PBT or taxable income? It's open for interpretation. If taxable income is favorable, then I'm sure the taxpayers will argue, no, this is not according to the agreement. This is our tax liabilities computed according to IRA. Therefore, only the rate is being taken from the agreement. Therefore, we should be governed by the taxable income rule, not the profit before tax. Right? But then all this, because of this, the way it is been worded, unless this is clarified further in the act itself, I think this can have interpretation issues. Now, this word, this clause is basically cut and paste from the Soup Against Tax, right? No, if you look at the precedent, to the best of my knowledge, the Inland Revenue Department at that time looked at only these companies to grant the criteria that time, right? In 2015. Right, the other one. This is the extreme one, where basically where the agreement straightforward provides after the expiry of the tax exemption, the company should be governed by the rules in the IRA in relation to calculation of the tax liability. So can this kind of a company say that they can use the PBT? The answer again is, if you look at take a broad interpretation, even this formula is basically coming from the agreement. So the decision of the BOI not to grant any concession variations after the expiry of the holiday is also a decision embedded in the agreement. So therefore, it's also coming from the agreement. So you can argue and take that thing. But you have to keep in mind from the taxpayer's point of view, most of the cases, PBT is not favorable. This is something that argument that you can expect from the Inland Revenue Department to come. But my point is basically, it's better that this should not be left open for interpretation, and this should be clarified exactly what is meant in this particular section. Right. So this is what I'm trying to point out. Even in the Soup Against Tax also, it's the same phrase that was used. So it's a cut and paste that we find here. Right. Now let's move on to another interesting one. In case of the dividends. Now, when we have a scenario, how in case of a group company, a holding company, and subsidiaries, as Mr. Ranavir rightly pointed out, you have to take the taxable income of both companies, holding company and the subsidiary, and then check whether a 2 billion criteria is fulfilled. And so that's the chargeability. For chargeability for 2 billion purposes, you have to take the taxable income of the subsidiary, taxable income of the holding company. That's what we find, what I've underlined in this particular section, applicable section. What I've underlined in blue is that's the chargeability. For the chargeability 2 billion, there is no exclusion of dividends. But when it comes to calculation part, according to this section, subsidiary company dividends could be excluded. So when you are once you decide the company is liable for surcharge tax because 2 billion criteria is fulfilled because of the taxable income of the subsidiary and the holding company put together is exceeding 2 billion, thereafter you have to pay in case of the holding company, deducting the subsidiary company dividends. 25% is applied on the taxable income after deduction of the thing, because this seems a little bit difficult interpretational issue, but I think when we break it in this manner, it becomes pretty clear. Right now, I'm moving into another interesting scenario. Right, we have we have two groups here. All four companies are liable for surcharge tax. So we have the holding company and the subsidiary company. This holding company owns 100%, and when this company is paying dividends to the holding company, this dividends will go out. This holding company has only 25% in this ABC company, which is its associated company. So when the associate company paying dividends, that dividend is not excluded. It is to be included in calculating the 25%. Straightforward, right? Now, in my next slide, I'm going to show you how the tax leakage happens when the this company ABC, that is when the associated company declares a dividends to the this company, the holding company, and the holding company is declaring dividends to the shareholder. What is the tax leakage, total tax leakage that takes place? And also in my example, I'm making an assumption on taking a situation where basically the entirety of the tax has been paid as interim dividend by the associated company to the holdco, and holdco also has declared an interim dividend, that entire amount as interim dividends to the shareholder in the 2021 interim dividend. Right? Because if it's the final dividend, then it's not coming into the 2021 accounts. In the case of the taxable income of the recipient company, it's the other, right? So let's see. How does this work basically? The interesting thing that I'm trying to show is basically what is the total tax leakage in this scenario. So what I'm going to give you on an associate company declaring dividends to the holding company as interim dividends during the year of assessment 2021, and the holdco declaring that same dividends as interim dividends in 2021 to the shareholder. So let's see, basically this company had 400 as the taxable income. This becomes liable for surcharge because of the holding company, and both put together that exceeds the 2 billion criteria. Because of that, this company is also liable for surcharge tax in my scenario that I'm taking. So taxable income is 4. So if it is 400, 25% shareholdings, therefore that part of the taxable income applicable to this green company holdco is only 100. Surcharge, the corporate income tax liability on that part of the taxable income is 24, assuming it's a 24% company. And the interim dividends, the remainder, the amount is basically paid as an interim dividend. And once that interim dividend is paid, after the payment, now comes in 21-22, surcharge tax has to be calculated at the rate of 25% on the taxable income, which is 25. So we have surcharge tax payment to the department, corporate income tax paid to the department in relation to this 100 rupee taxable income. Now that out of that 776 paid as interim dividend to the holdco in 2021 itself. So when that is received here, I'm disregarding the policy of deducting expenses and the losses, etc. I'm straightforward, I'm taking the 14%. And on 14% on that, the exposure is 10.6. And after deduction that, the remainder interim dividend in 2021 itself, interim dividend is paid to the shareholder, which is 60.54. And come 21-22, surcharge tax has at the rate of 25 should be paid on the taxable income, that part of the taxable income of 76, which is 19. So then we have 4 payments going to the Inland Revenue Department in relation to this 100 rupee taxable income that was made. So you can see what is the total payment that is going to the Inland Revenue Department. By way of corporate income tax, we have here and here in 2 companies, there's a total of 34.6 going to the Inland Revenue Department. By way of surcharge tax, we have 25 here and we have 19 here. There's 44 going. So altogether, we have 78.6 tax leakage due to this 100 rupee taxable income that was made by the ABC company, associate company, which is liable for surcharge tax when the dividend is pushed through the whole core to the ultimate shareholder, the tax leakage, how much? Surcharge tax, you have to keep in mind, is borne by the company. It's not going to the shareholder in this year, but the repercussions of that payment, that surcharge tax reduction, will come obviously in the subsequent year by way of depletion of the dividends in the subsequent year. So this is something that I wanted to give an idea, right? Right. Just to give you an idea with regard to who is not going to get affected by the surcharge tax. Now, in the surcharge tax act itself, bill itself, we don't find any exemptions granted. But nevertheless, if there is no taxable income, then there will not be surcharge tax. So that's the principle that we have to go by. And so, if any taxpayer who is getting exempt income which is exempt from income tax will not have surcharge tax. So who are the categories? And when you look at the third schedule, the categories that are there are listed here so that you can get an idea who will not be liable for surcharge tax. And when it comes to companies, a person who is solely engaged in sale of produce from agro-farming, information technology and enabled services, and the persons who gets only exempt income or foreign currency income from services rendered in outside Sri Lanka to any person to be utilized outside Sri Lanka category, and then foreign source income where it is received only if it's foreign source. Now that category will not get affected by surcharge. Then we have the companies that enjoy concessionary tax rate. These companies, notwithstanding enjoying concessionary income tax rates, if they have more than 2 billion taxable income, there is no mercy. They will be exposed to surcharge tax. Is something that we have to keep in mind. So any business of sale of goods or merchandise where the foreign currency is involved, the 14% rates, export of goods are 14, manufacturing 18, promotion of tourism 14, healthcare 14, agro-processing 14, providing construction service 14. Then we have the specified undertaking category, and that includes entrepreneur trade involving import, minor processing and re-exports, and the offshore businesses, front-end services, and headquarter operations, logistics, transshipment, freight forwarding. Now, all these basically are in the concessionary rate list. But any of these companies hit 2 billion either on their own or being a part of the group, then what happens is 2 billion group, then what happens is the surcharge tax will come, right? So that's something you have to keep in mind. Right. Now, when it comes to group of companies, again, the definitions that have been given are basically from the super gains tax. All the flaws that were there in the super gains tax drafting are repeated in the surcharge tax bill drafting also in relation to these two definitions. Now, I'm not going to speak on this. People who know will understand why I'm circling this two words. And okay, to explain you basically what is covered as the group, as a holding company or a group of companies or as a subsidiary company. Now, if you have a subsidiary, if you have a holding company in Sri Lanka and the subsidiary company in Maldives, this is not be taken as a group here. This company will be liable. Only this company will be liable. Only this company has 2 billion. There is no taxable income for this company. No tax on that. But however, if this subsidiary in the Maldives, Sri Lanka, holding company in Sri Lanka, subsidiary in Maldives, has a branch in Sri Lanka, then in calculating the taxable income, aggregate taxable income, holding company's taxable income and the branch's taxable income will be aggregated to see whether there is 2 billion criteria fulfilled. If that's the case, this holding company and subsidiary will have to pay surcharge tax. Likewise, in case of a foreign holding company, let's say the holding company is in India and the subsidiary is in Sri Lanka, then this company, unless this has 2 billion on its own, there will not be addition of these two, right? So this company will not be looked at. But however, if the holding company in India has a subsidiary in Sri Lanka, which has, let's say, taxable income only 1.5, but it also has a branch in Sri Lanka, which has a taxable income of 0.8, then these two will be aggregated to see whether 2 billion criteria is to be fulfilled. This is what we find in that language of the definition of holding company and the subsidiary. I'm just putting it to diagram so that you can digest it fast, right? Right. Then if you have a scenario of this tense, now the holding company is outside Sri Lanka, there's a subsidiary in Sri Lanka with 1.5 billion, and there's a sub-subsidiary with 0.8 billion. If that's the case, if that's the case, then the subsidiary and the sub-subsidiary put together, if it's above 2 billion, then these two companies will have to pay surcharge tax. Right, my last slide. So there are many permutation and computations are possible. Basically, if you look at this surcharge thing, and there are so many, I think the planning opportunities also there. I don't know your planning opportunities or whatever the flaws that are there in the drafting, which can be used sometimes. But all in all, basically, to sum up, basically, let me put it this way. Now, what happened was on 7th of February, after the cabinet approval, on the 7th of February, the bill was published in the Gazette. So according to the Article 78 of the Constitution, the bill should be placed in the order paper of the Parliament only after 7 days. So what was published on the 7th February, I think that's after 14th of February, at any time now, it could be placed in the order paper. Once it is placed in the order paper, there are 7 days for it to be challenged in the courts according to Article 78 again. And if it is challenged in the courts for its constitutionality, under Article 121 of the Constitution, within 3 weeks, the determination should be given by the Speaker. Sorry, should be given by the Supreme Court to the Speaker. It should be delivered within 3 weeks. And then again, it will be placed in the order paper, and the first reading will take place. And after that, we will have the second reading and the voting, and then the committee stage amendments. We believe that there will be changes that will happen here, the way it is going. And the third reading and the voting, and thereafter certification by the Speaker under Article 79 and 80 will take place, and then thereafter it becomes law. And after that, under Article 80 subsection 3, there's nothing anyone can do. It becomes a law. Nobody can question the statute once it's certified by the Speaker. So that's the future that is there for us to see in relation to the surcharge bill that we are debating today. Right, that's my last slide, and with that, I will hand over my presentation, the screen to the moderator. Thank you.
Thank you very much, sir. Next on agenda is the panel discussion moderated by Mr. Duminda Pulangamua, Head of Tax, Ernst & Young, and the Deputy Vice Chairperson of the Ceylon Chamber of Commerce. He has served as the Chairman of the Faculty of Taxation of the Institute of Chartered Accountants of Sri Lanka for the past 4 years. Joining us as panelists are Dr. Rajabaksha, Managing Director, DSI Group of Companies, Mr. Gajendran, Senior Partner, Gashman Company, and Ms. Nasreen, Head of Corporate Finance, Group Tax and Social Entrepreneur Project at the John Gills Group. We invite you to send your questions and clarifications on the question and answer or chat. Over to you, Mr. Duminda Pulangamua.
Yes. Good afternoon, ladies and gentlemen, and thank you very much to the CMA for inviting me to be the moderator of this session. The panelists have already been introduced, so I think both Suresh and Mr. Ranavira dealt extensively on the law itself, its implications, the application, all that are very thoroughly dealt by Suresh. So some other questions, therefore, I think have been answered already, Suresh. But in the panel discussion, I want to concentrate more. Suresh, you, myself, Ranavira, and perhaps Gajen, we only advise clients to pay or not to pay. These are clients and our taxpayers who are in the forefront of this tax and who have to bear the cost of the tax. So, in that context, I want to raise my first question to the industrialists who we are having in this discussion. So I want to first ask a question, Dr. Pulutuga Rajapaksa, of course, who I have engaged before on this matter. I want to, before asking any questions on this, Dr. Rajapaksa, I want you to give me your views. I'm sure they're not positive, but your views and what you feel about this tax, and how is there an alternative we can suggest to government instead of this tax, how else can they pay revenue? So over to you for about 5 minutes, if you can explain. I know your position already, but you can please explain yourself to the audience.
Good afternoon, everybody. Well, we are at the receiving end of this tax. So we had mentioned that, being large corporates, we do have a corporate plan for 3 to 5 years. So therefore, the cash flow has been already allocated. So therefore, there is no funds that we are reserved for this type of ad hoc taxations. So of course, the cash flow has been affected. When other point is, this, as Mr. Ratula Ranamira mentioned, the threshold has been taken as 2 billion. The company that is at 1.99 billion will not be qualified for this payment. So therefore, once you pass the threshold, we have to pay the tax for the entire one. I think that's something that should have been considered. The tax has to be paid not by the group, but it has to be paid by the sub.
Yes.
Yes, we agree that government needs funds. So
Yes, please.
because of the COVID situation, government needs funds. We as industry, we agree that there's some amount of funds required. But the question here is, there's no provision in the corporate plans of most of the companies for this tax. So therefore, they expect some sort of relief when they pay it, to treat this as something like advanced corporate tax, where this can be set off against future tax. That would have a little bit of relief, because already the investments have been planned by all the companies. As far as our company is concerned, we know that there's a serious shortage of dollars. So we are planning our investments to generate more dollars, because dollars are required to run the other companies. So that plans have been there right throughout. Now with this one, that we have to shelve that plan, and that will definitely affect the long-term development of the country. So therefore, this is something that would have been taken into consideration. Then other point is about the payment of tax. The first installment will be due next month. So that means it will fall into 21 and 22 accounting year. But it is very unlikely, as Mr. Suresh mentioned, by the time it goes through the parliamentary procedures, I don't know whether that this tax can be paid during the financial year 21-22. It might fall into 22-23, probably. So I don't know the accounting aspect of it on that. Then other thing is, I was made to understand that at the very outset, only 62 companies will be liable. Now I understand that that statement is not valid. Then there are more than 200 companies qualifying for this payment. So that means if we take the average of 5 billion at the 25%, we are trying to collect 250 billion by this tax. But if this has been brought down, as suggested before by other tax experts, a flat rate of 10% and broad-based this one, surely this should have been collected in that manner as well. But that are not being considered. So therefore, this will definitely stop all the expansions of large companies. They may have to not, cash flow is, because the profit is something, cash flow is something else. So profit is not all in cash. So those are linked with the stocks and assets. So to pay this tax, most of the companies may have to divest certain assets, because there is no way, they have no way to get these funds at this moment. Because by next month, you have to find fairly big amount of cash to pay this tax. So therefore, in the long run, there will be a serious serious impact on the profitability of the companies and eventually the development of the country. That's the understanding that you have. Thank you very much.
No, I think you made a very valid point, Rajapaksa, with regard to the company's ability to invest for expansion and for new investments will get impacted by this, because I mean, if you're at 2 billion, you're basically talking 500 million tax. So, so I think the point that you made with regard to inability to expand and the fact that will affect development and employment in the future is something the government has to consider. That's a very valid point to take from this session. So thank you very much for making those points, Dr. Rajapaksa. May I turn to Nisreen? Nisreen, I know that you're an expert by yourself, but you represent one of the largest conglomerates in Sri Lanka, John Fields Group. You know, this concept of group taxation we don't have in Sri Lanka, but only when the government wants to bring group taxation into the picture. There's a lot of debate and noise also made by the fact that, okay, there are so many joint ventures that companies like you all have entered into with foreign participants, with local participation, similarly other group companies as well, that just because we become a part of a group,
I think you went on mute. Yeah,
you are
sorry.
not audible to me, though.
oh,
You are not audible.
okay, I can't be heard, is it?
Can
you
hear
can.
now.
Now can. Now can.
Can you hear me now?
Now yes.
Yes.
Sorry, something my headphone goes off sometimes. I don't know what happens anyway. So sorry, thanks, Gajan, for that. Sorry, Nisreen, I don't think you got the full question that I asked you. So my question to you was, being a part of a conglomerate of a group companies, some big allegation or debate that is going on, or complaint rather made by the minority shareholders. And as a minority shareholder, I'm not talking of individuals. I'm talking of joint ventures that have entered into, which have 40%, 45%. You know, those people are saying we get called into this tax unnecessarily because we are a part of a group. What is your perception about that, and how do you think that matter can be handled, if at all?
Right. Thanks for the question, Dharmendra. Before I get on to answering that particular question, let me just take a step back and recognize that as a group, we understand that the country needs the funds, and that, you know, it's tough times, tough decision needs to be made, and we don't have a problem sort of playing our part in it and contributing to that, you know, collection. So that goes without saying. The fairness of the tax is the challenge, and sort of linking up to what you were saying, Dharmendra, especially being listed companies, and we have 9 listed companies within the group. So you do have your minority shareholders. They invest taking a position on, you know, what the expected projections of the company is, what are the tax rates that are there, etc. And you, I mean, also just going back one step, when we were going through COVID, it's not that all companies, I would say, took hard look, internal look at themselves. I mean, most private sector company employees took pay cuts. We deferred capex so that, you know, you could keep the companies going, you know, reasonably well, to see us through, kept our heads down to see us through the tough times, so that you can then, you know, once you come out of it, you can then, you know, utilize those funds and invest on things that you would have deferred for years. So all this, you know, people generally take a long-term view of companies and how they invest, and not having certainty in how things are done. And more than certainty, I think the fairness of it also gets to you, because like I think some of the other speakers also mentioned this. Now, just because a company is part of a group, the minority shareholder or even the majority shareholder of that company, why should that particular company get penalized when a competitor in the same industry of the same size would not pay any taxes, and then be able to use that funds to expand and get ahead of you? Why are you penalized as being a group? Then also, I would just want to mention this couple of other things also. When I think there's this perception that group companies set up new companies to avoid maybe regulatory obligations, or, you know, to break up their profits or whatever. but most companies, that may be happening. I'm not saying, I'm not denying it, but multiple companies are set up for strategic reasons. They may be doing different businesses. So why you would go about consolidating all these to arrive at a 2 billion threshold? And also, who decided on the 2 billion threshold? What was the logic of that 2 billion threshold? So, for example, if a company has capital investment of 20 billion and makes 2 billion, what's different in that company versus someone who invests 2 billion and makes 200 million? It's the same return on investment. So why this line of 2 billion and saying if you have made more than that, even at 2 billion, you may have been suboptimal in terms of your return to your investors, right? And I think banks have this concern that, based on the amount of capital they have in the business, the returns are not, though you would see a large number. So I think the concern with these one-off taxes is, and again, going back to the point that it's not that we have a objection to paying a tax, which is if the country needs it, subject to some of the points Suresh made as to why did we have policies which reduce the tax base and then now introducing these kind of taxes. But leaving that aside, it's not about not wanting to pay. It's about the tax needs to be seen to be fair by all taxpayers. And why is it that it's the same taxpayers who are compliant and contributing who are called upon day in and day out to contribute more and more and more? And even the concept of groups, listed companies, as you would have consolidated financial statements available to know that it's part of a group. But does the Inland Revenue or even the regulators have a process of identifying all the companies within all the non-listed groups? Is that transparent? So how is it always going to be the compliant taxpayer who's been called upon to keep paying taxes? Or should we introspect and say, you need to be fair. Only then can you have the, your taxpayers wanting to and willingly paying taxes. Giving amnesties once in a while doesn't make, touch the tip of the iceberg. So I think it's about taking that step back, Raminda, and understanding as to what a policy framework is all about, having certainty, being fair, being reasonable, and being transparent. I think it's a couple of things Suresh touched on also about, let's say, for example, dividends. Why was only subsidiary dividends excluded and not all dividends? Because, for example, dividends are taxed twice already. So by bringing it into the net for surcharge tax, you're taxing it the third time, irrespective of everything else. So it's taxed at the company level, it's taxed at the recipient's level. So why, I mean, is it that it's not been thought through? Is it just obviously something that is rushed in because there's a shortfall in revenue and we are looking at gaps? Even if that is the case, should the private sector not be consulted more to understand and identify the challenges and issues? And as I said again, it's not about us not wanting to pay taxes, but maybe we ourselves could have suggested a better way of doing this. Maybe something where it was definitely broad-based, maybe everyone being called upon to pay their fair share. And I think most probably the targets may have been achieved and even surpassed if that was the case. So a couple of thoughts on that from my side.
Thanks, Nisreen. Is it audible? Can you hear me now?
Yes.
We can hear.
Can hear, okay. Right, thanks, Nisreen, for the detailed explanation. I mean, we have been talking about consistency, conformity, fairness, equity. I mean, the last 20 years probably we're talking about this, right? But successive governments always say they are consistent, but they are not consistent in what they do. Right. So my next question is to my friend, Mr. N.R. Gajendran. Can you hear me, Gaj?
Yes, I can hear you.
Right, okay. Gaj, I know your views. I have heard your views on this matter a couple of times. But Gajen, what is your view? I mean, is it fair to take a segment of the taxpayers that earn above a certain figure? Is it because they are efficient? Is it because they have invested large amount of capital than the others? Is it because they have got their expansion right? I mean, basically they've been operating efficiently. And then, as Dr. Rajapaksa said, here government comes and says, okay, if you owe 2,000 million, you're penalized for being efficient, for being big, for being large. So you come on and pay this amount to us. Is there any equity and fairness in the whole process, as opposed to Dr. Rajapaksa is not saying that, we are not saying don't take that. The government has a problem. Okay, we are here to support you, but make it in an equitable and justifiable way, rather than make a figure like pluck it 2,000 and say 2 billion from somewhere and say, okay, pay the 2 billion. What is your view as tax expert and as a person who's involved in the economic side of it as well?
Yes, thank you, Dimunda. If you see now that you're talking of equity and fairness, first of all, there is no fairness in taxation at all, right? That is the first principle. There is never a fairness in taxation because it is your legitimate money that is being taken away by law. But the imposition of tax has been accepted by all countries. And from lines of economics, a tax to be efficient, there are two fundamental qualifying criteria. That is, if one is, they say, am I audible?
Yes.
Yeah, we can hear you.
One is saying that your revenue raised should be adequate to meet your expenses, also take care of your debt repayments. That adequacy, that is one is the test of efficiency. Other one, it should satisfy the test of just and fairness and equity. That is in short, is the ability to pay, the principle of capacity to pay. I've always advocated this principle of capacity to pay right throughout. Even in the case of value-added tax, I was always campaigning, articulating, saying that it's even a differential rate, multi-rate system instead of standard rate system in the ability, the capacity to pay. Now, if you see if you put that principle into place, and this is the best form of tax to my mind, because it is not on small people who are affected. It doesn't mean these large companies have not been affected. All have been affected. And the government made a conscious decision, which was whether it was scientifically decided or not, but it came in the presidential manifesto also. They will be imposing simple taxes and they will be removing the burden of the taxes. And they went on so much, they removed so much of taxes. And basically now we are only left with income tax and VAT. And that's also a very high threshold for VAT and a pretty high threshold for individuals, which is even compared to developed countries. Our threshold is higher than the threshold you can find in some of the developed countries, they say even in Singapore. So now, having done all that, they initially expected to lose about 200 billion or 300 billion. But maybe with COVID, it went to almost reach 550 or 600 billion. So they have lost a chunk of revenue. And that was the reason why they had to go to this MMT theory, and they have gone continuing printing money. And in 20 and 21, I think they have already printed 40% of the money that was in circulation. That is over 3 trillion rupees. Now they can't go on with this. And of course, this budget if you see in 21 budget that was presented in 20, a lot of people thought that there will be a reversal of the tax policies. Many thought because of COVID hitting in March 20 that they will reverse these policies, but they gave a pledge. Other than, there are so many laws are made on a daily basis now on gazette notification, which is becoming a periodical and is changing day by day. Apart from that is the fact of the matter. But on this tax matter, they said we will hold it for 3 years at least. Initially, they said 5 years, then they hold it for 3 years, and they've held that. And now what they are doing is the state wants to raise some revenue, and they're picking 60 odd people. And when this number of more than 100 or 200 people being saying that is because of the group of companies, that doesn't mean all the companies are going to pay. They are paying their profits over 2 billion rupees. There are some companies in the group, because the group hits 2 billion, about 20, 25 companies or 10 or 15 companies all had to pay the tax in whatever the amount of tax they have. See, on those principles, I have nothing. It's better to tax 65 people or 65 groups than to go and tax 650,000 people or 6.5 million people to raise the same amount of tax. So, and this is not the first time the objections, the articulation, the justification on what has been stated. It is always there when any tax policy is put forward. You need money for investment. You mustn't tax you mustn't tax out of capital. You can't tax reserves. Although then we have accounting problems. But when basically they want to raise revenue. There is long and short of it. I think no one said anything from the budget when it was presented in November. It was presented. There was no much of objections. Even now, what Nisreen said, in fact, personally, some of the CEOs have also spoken to me, and some of them spoke when this budget was on that particular date and said, look here, we don't mind paying this tax straight away without knowing what was coming with the budget. They said, we won't mind pay. Only thing is the government is allow us to do the business. They must allow us to do business. We can't stop the business. So now that is the bigger problem all these companies have. And also, if you see in the last 1 or 2 years, for more than one reason, these large corporate companies have accumulated greater profits than ever before because of certain advantages that through the small companies have gone. If you see what is published in the accounts, naturally it's tempting. So someone, when it is for disclosure purposes, transparency purposes, when it is published, the profits are soaring for these companies. On those accounts, this is the fair amount of tax. Yes, this is tax after it has happened. It happened in 2015. 2015 also the same situation happened, whether it was spoken with same extent. And also currently we must realize that I'm told, I think I read this also, there are about 4 million self-employed people and daily wage earners, and out of them about 60-70% are now they don't have employment in that sense. So all are struggling at the moment. There is no question about it. So big, small or large or ugly, it's all struggling. And the government is also struggling. And if you see the exchange is getting worse by the day, now even people are not able to find little money. Now people are traveling little money even in currency to get, and you have to speak to so many banks. So times have challenged. So this tax has come, and the alternate suggestions, to my mind, whether they can make technically they can make only committee stage amendments errors. Of course, they can exclude things like the EPF and ETF. I think the greatest objections that came was EPF and ETF. And I think all of us knew, I particularly knew that they will never go ahead with that. They will withdraw that, and that has been done. A lot of 40 hours spoken on that. I think once that is gone off, the heat will be off on this tax. EPF, ETF on means then the heat will not be on this tax. Yeah, there are other justification and arguments and debates which has been expressed that, look here, this is not fair because this is post-tax, retroactive tax, retrospective tax. All that debate is there. But when you take the economic concept of efficiency and the ability to pay, it is better to tax. Even theories of hedonic framing is there. Theories to tax about few people than to tax a large number of people. Then there will be a public outright. Yeah, then there will be a public outright. So it's the sentiments are both ways. But if the government wants to change this, I don't know whether they will change it. They're going to change or make major variation. Then they'll have to withdraw the bill and put another bill which has to go through the debate, because this was proposed in the budget, it was debated and it was passed. And now it is on the cards for them to go ahead with it. If they're going to make substantive changes, then it may not be possible to make substantive changes generally. Of course, they can do anything now because of executive power and also 2/3 majority. So they can do anything, and as Suresh said, once it's legislated, even if it is unconstitutional, once it's legislated, the law will remain. So we will have to live with this unless otherwise the government is prepared to make a major U-turn on this matter.
Thanks, Gajen. You're aware body armor when you're walking on the road.
Sorry?
You're aware body armor when you're walking on the road, I said.
Why? I thought you should
you said it's better to tax 65 people.
better to tax
Sorry.
65 people than to tax 6.5
Yeah.
million people.
So, anyway, thanks, Gajen, for being frank as usual. I want actually throw in a question to Professor Vattawala, although he's not a panelist. I'm sure he's qualified enough to answer this question. You know, Professor, one of the biggest allegation charges against all these taxes is that there's no transparency in the spending. You see, you collect 100 billion, 150 billion, then what are you going to do? Are you going to pay compensation to farmers? Are you going to pay some of the people? Are you going to plan 100,000 projects? I mean, those are some of the questions people are asking. This issue of transparency in the spending pattern. So you being a part of the public service at one time, what is your reaction to questions being raised at that?
Yeah, I think what I would like to say is that if the private sector is being taxed and charged, then of course with greatest difficulty that they will pay, similar reaction should be there on the other side also, no? Because they will have to cut down their expenses. They will have to show the value creation, what they are doing with the money that is being spent. So I think all those are necessary. And also maybe now at the moment, the biggest problem is that we need the foreign exchange. We need the exports to go ahead. Then we find that there are so many problems like employment, they can't get the people to do the most of these jobs. So I think the government has to assist in that situation, because one of the things that we have now suggested is to get the Samurdhi department, where they can get employees, where they can find the people to give jobs, because the private sector is having, I'm sure, about 100,000 jobs that are available. But unfortunately, they can't find the people. So if that sort of thing is available, then we will find that there'll be money, people will be able to get a good job, but they can also work. And that will also help them, because government will not have to subsidize these people if they can get the jobs and work, So I think government has to look at that direction and give all the support to the private sector to encourage them to improve their export earnings, while they are definitely cutting down the expenses, because otherwise they can't go to banks and get loans. But government also will have to cut down expenses as much as possible, and also have the value creation. Value creation is very essential. If this tax is taken, they must tell what purpose this is being used, and what is the value that they are giving to the society. So I think this is the biggest question that is being asked.
Thank you, Professor. My next question to Suresh. Suresh, can you hear me?
Yes, go ahead.
Yeah. Suresh, now there is a lot of talk about it being retrospective tax. Just want to ask you, since your legal background, one can also say that the tax is being charged as a current year tax. They're only using the previous year as a basis to determine the tax. So is it really retrospective in nature? I mean, all that legal challenge is retrospective in nature. Is the question I will ask you.
Yeah, so this is I think open for interpretation. Now here, what happens is, in our slides I pointed out, basically, current year tax liability is basically being computed on a previous year basis, preceding year basis. So we have seen this aspect in so many other taxes as well in the past. But the difference here is it being charged to the financial statements of the previous year itself.
Yes.
So that is not the case that we found.
But I think that was given more as a request from the private sector rather than as they thought they're giving a benefit to the private sector. I think that must have been the context in which it came.
Yeah, so basically that is the that aspect is different from this simple, straightforward preceding year basis that we see in other taxes.
Yeah, thanks, Suresh. Is Mr. Ranavir on the call? I can't see him. Is Rajendra? Is Mr. Ranavir on the call?
I'm there.
Yeah.
Mr. Ranavir, my call. Next question is to you. Now this question of assessment. Now, say for example, a person pays his tax based on the 2021 profits, and say a year or two later, the 2021 profits, the 2021 taxable income is assessed for additional tax.
Yeah.
Right. And then what happens? Will there is an additional assessment for the surcharge? By that time you have paid the surcharge. So you have 2 billion income, you paid 500 million surcharge. Money down the line, there's department audit of the company and they say your profit is 3 billion. And then assessments are raised. And say you fight the case right up to court, isolations can come in here. And then the court takes other 5-6 years or 7-8 years to settle the case. And you lose the case in the department. And then the taxes assessments are upheld. At which point can the department come and say, hey, your surcharge should have been not 500 million, should be 25% of 3 billion. So I'll leave it to both Atula and then to Suresh to answer that question. It's a more legal question, more technical question, hypothetical maybe, but I want this thing to be clear.
But here
Yeah,
it says the time bar is still 31st,
That's right.
31st December, 31st 2024.
That's right.
Therefore, after 2024, they can't issue assessments. Now with that,
Yes.
if the figures change subsequently, they can't raise assessments after 31st December 2024. Therefore,
Yes.
I think taxpayers are secured with that.
Suresh,
Yeah, that is what I think.
your view, Suresh, on that? Is that the same view? That
Yeah,
you have,
I tend to agree with Mr. Anavira because there's express provision in the bill itself to tell what the time bar is. And when there's such a specific express provision, I don't think there's any room for raising an assessment on any other ground, whatsoever after that date.
Okay. Thank you, Suresh. Just before I conclude, I want another round of questions, Mr. Professor.
But
if I have,
Bhumika, on that, practically,
yes, go
the
ahead. Hitachi.
Department of Inland Revenue is not going to do what we are discussing now.
Yes.
If they issue an assessment for income tax,
Yeah.
and if that company is already a company which is liable for surcharge tax, they will immediately, consequentially, they'll issue an assessment and keep the matter open.
Yes.
They are not going
Right.
to do
Wait
what
for the determination to come from court.
they are not going to wait till the whole thing is done. So
Yes.
then the company will have to contest both assessments.
Yeah.
You know, and to see.
And those are the issues that will come up later, which none of us foresee at the moment. That's a good point you raised. Thanks. Professor, I have 2 more questions. I know I'm running short of time, but I want some questions to be thrown at the screen again. In this super gains plus with a surcharge, they have not imposed on exempt persons. I'm not by any means saying they should impose, but there's debate. The exempt persons also get away. If it's a surcharge or super gains or income tax, whereas the person who pays the same orange gets squeezed, right? What is your view? I know you're in a group, you must be having both exempt and liable companies, but what is your view on this across the board? If you take an independent view, what is your view? Is it fair to leave them out and tax only the others?
I think it's a broader conversation, Duminda. It's not only the exempt companies. What about the companies that earned 1.999999?
Marginal relief.
So it's a much wider conversation than the exemptions. But in a wider conversation, if you're looking at really broad basing, and in that context, if you're saying, even though we have given exemptions and investments have been made relying on those exemptions, we have done based on that, but the country needs it, then I think it's a fair ask, but it has to be part of a much, much wider debate, and it's not going after the same goals, so to speak. So why go after the exempt companies before you go after the companies that had 1.9 billion profit? So I'm not saying yes or no. I'm just saying that it has to be a much wider conversation. You need to also consider things like, I think Suresh made a very valid point, companies who have been given concessionary rates. Why are they being taxed at 25% when they have been given concession rates? I mean, practical issues, these 2 points didn't come up, but for example, in a group company, for example, John Case, we have leisure companies, right, who have taxable income purely because you can't say they may have some rental income, whatever. So these are companies who have suffered, but they still are called upon to pay taxes because it's a wider group. Then I think one point that I don't know whether anyone has identified is life insurance companies. We've been talking about EPF, ETF, but in life insurance companies, the policyholder's tax is paid by the insurance company. And if that insurance company either has over 2 billion taxable income or is part of a group, you are actually taxing the profits of the life insurance policyholder. Has anyone even considered that? So I don't know whether people have really thought through this enough, understood on all the implications. And going back to your question, if there is a fairness in the way it's been implemented, I don't think anyone would have a problem contributing their fair share.
And that was my first question to Dr. Rajapaksa as well. Dr. Rajapaksa, I'll have the final question to you. Are you online?
Yes.
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 There's a question that has come from the audience, which I want to put it to you. There are a lot of employees and their families affected who work for this penalized group of companies or in over 2 billion. The salaries and growth potential will be minimized and will have a direct impact. The companies have to pay unnecessary taxes imposed, they will get it out from somewhere else. So their fear is that these cuts of tax that you pay will be taken out of employees' expenses, etc., in order for you to give a return to your shareholder, etc. Is that a correct statement that someone is making?
Yes, since this tax had not been planned before, and it is based on 2021, and most of the companies have planned their investments and investments on this cash flow that is available. So to pay this tax, they have to cut down. They have to cut down certain expenses and investments. So naturally, all expenses we may have to curtail because this has to be paid by next month. So therefore, as far as our company is concerned, we will have to dispose certain assets, we have to reduce expenditure, and we find this cash to pay this fund. So therefore, ultimately what happens is all our investment plan that will be contributed to GDP of the country. So when we stop those investments, naturally in the long term, there will be a serious drop in total revenue. That's going to happen. So expanding of the company to be reduced. The moment we expand from machinery, we take new employment. Now those expansions has to be sustained, curtailed until we pay these taxes. So naturally, the whole supply line, the whole chain will affect. That is going to happen. You can't prevent that. Long term, there's a serious issue on this because the amount is very weak. That's the reason. Thank you.
Thank you, Dr. Rajapaksa. I think for those candid views you expressed. Rajendra and Professor, ladies and gentlemen, it's 5 o'clock. The time I was given to conduct this panel discussion was until 5 o'clock in the evening. And I hope I have asked the relevant questions for the panelists. There are some questions from the audience, but those were covered in Suresh's presentation. I want to take it up again. I know it's not, I mean, there are always two sides to coin, you know, some will be in favor, some are not in favor. Government has to raise expenditure, has revenue, but it has to be fair amongst everyone. So all these arguments are there for and against. But in the end, you know, business has to be given the space to operate, to expand. The private sector is the only one that is growing in this country, and taking away money that is available for investment for the private sector, if it is used for something that is unviable, that is to return to the country, there is a waste. So that's where I come from. And with that, Gajendra, I hand over the session to you. Thank you very much, everyone, for listening to this panel discussion.
Thank you. As we come to the end of today's proceedings, now I invite Mr. H.M. Henaka Bandara, Vice President of CMA Sri Lanka and President of SAFA, to deliver the vote of thanks. Over to you, sir.
Thank you, Gajen. Ladies and gentlemen. It is not an easy task to make the concluding remarks covering all the areas the eminent speakers and panelists spoke of. But let me take 3 to 4 minutes to highlight a couple of important points. Whatever the course of action the authorities may take, it is an additional cost to the taxpayers. This is specifically relevant to EPF and other similar funds we spoke of, because they do not maintain mega cash balances to pay the surcharge. hence, it will have to dispose some of the treasury bills and treasury bonds in the market to pay this surcharge. The reason being that almost all these funds have invested their surplus fund treasury bills and treasury bonds. To me, the implication on this will be that since the interest rates have increased in the last few months, the market prices of the securities have fallen. As such, when they seek to dispose some of them in the market, it will have to incur capital loss, which will in turn be passed on to the members of these funds. In fact, even though the decision is not yet been implemented, the parliament has not yet been passed, the law, currently almost all the funds are discussing on this matter. In the event if they implement this decision, how they could really find the funds or other cash to make this payment. The second point that I would like to mention is that the authorities had been forced to go for these extraordinary measures because they had made a serious policy error when it announced attractive tax concession to income taxpayers as well as the value-added taxpayers 2 years ago. This is the point that Mr. Suresh has pointed out. Then the next point is that the authorities would have thought that this was an easy marketable tax proposal because it is imposed on the super rich of the country. But we had been ignored. But what had been ignored is that these super rich companies also employ the ordinary citizens of the country. So that's also another important point that I think the discussed Professor Vatawala mentioned in his opening remarks, the problems that the employees may undergo in this private sector company. The last point I would like to mention is that instead of going for this mega surcharge, whether authorities should go back to the tax regime that had been in force prior to 2009, and more importantly, improve the collection of taxes. I think that is the point mentioned by Mr. Gajendra as well as the Suresh. If not, they will face this problem in the future as well. Moreover, if the present surcharge is repeated, it will certainly affect the large business numbering over 200, as mentioned by Mr. Kulathunga Rajapaksa. But for the time being, even though they have mentioned the number is roughly about 60 to 65, but by the time when we implement this fund, it may be sometime much more than that or maybe less than that. So, ladies and gentlemen, with that note, on behalf of CMA, let me thank the two eminent speakers, our able moderator and all panelists for taking time off from their busy work schedule and sharing their knowledge, expertise, and experiences among all of us. Let me also thank our President, Lakshman Vatawala, Committee Chairman, Mr. Gajendra, members, and all participants for your participation. Thank you. Stay safe. Over to Ajay.
Thank you. Professor, anything you want to mention?
Yeah. Okay, thank you. Thank you. I think our moderator plus also all our speakers and panelists who have been thanked and also our participants. I think this was something very useful, and I'm sure that this will also create and give the real meaning of this tax on the large companies, on the employees, and also on the economy. So I'm sure this should be something that will be useful to everyone. And let me thank everyone for their valuable contribution and also to all our participants. Thank you and all the very best to you. We will conclude now.
Okay, thank you.
Thank you. Thank you.
Thank you, Suresh. Thank you.
Thank you. Thank you.
Thank you.